The National Housing Market reports are telling you a dangerous lie. While experts predict a modest 2 to 4% national price growth for 2026, they are ignoring the local fires already burning. In cities like New Orleans, prices are set to fall by over 7%. In Phoenix, some analysts are saying a 25% collapse is coming. This is a series of brutal, localized sinkholes. Yes, this video is your warning, but it's also your roadmap. I'm gonna pull back the curtain and show you exactly what the national headlines are missing. First, I'll identify the 10 US cities on the verge of a major decline. Then we'll expose the hidden forces, from insurance meltdowns to population decline, that are driving them toward a crash. But most importantly, I'm going to give you a clear, actionable playbook, not only to protect your capital, but also to position yourself to build wealth when others are panicking. So the first cracks in the foundation are not appearing because of mortgages or even interest rates. They're appearing in a place most investors don't even think to look until it's too late: the insurance bill. In places like Miami and Cape Coral, the dream of sunshine is turning into a financial nightmare. After years of hurricanes and floods, these insurance companies are fleeing the state. The ones that are left are raising their prices to unbelievable levels. Let me give you a number. In Miami-Dade County, home insurance premiums have exploded by 322%. What used to be a few $1,000s a year is now becoming a second mortgage payment. Miami homeowners now face the heaviest insurance burden in the entire country. Think about what this means for you as an investor. You can't get a mortgage without insurance, right? As these costs start to fly out of control, the total price of owning a home becomes impossible for the average person. This crushes the number of potential buyers. It's no surprise that CoreLogic, a major real estate data firm, has flagged Florida markets as having the highest risk price of decline in the entire country. If Florida is a story of a broken system, our next group of cities is a classic taste of flying too close to the sun. During the pandemic, cities like Austin, Boise, and Phoenix became the darlings of the housing market. Remote work and a flood of out-of-state money sent prices soaring. Now, gravity is taking over. Let's talk about Austin. At the peak of its frenzy, the price to income ratio was 5.75. What does that mean? It means it took almost 6 years of typical local salary just to buy a median priced home. The historical average, you ask, is under 4. That is what we call a bubble. Now, Zillow is forecasting prices to drop by another 4% heading into 2026. And the story is the exact same in Boise, Idaho. The explosive growth has slammed to a halt, showing just 0.4%. One data firm, Reventure, gives Boise a forecast score of 41 out of 100. For reference, anything below 45 means that market is actively declining. But Phoenix is where the alarm bells are actually the loudest. The number of homes for sale has shot up by over 65% from last year. Think about that. For every 2 homes on the market last year, there are now more than 3. Sellers are in a panic, slashing prices by $80,000, even $100,000. Some analysts are warning that Phoenix could see prices fall another 25% by 2026. These markets were built on what we call hype and not fundamentals. For investors, this is your classic warning sign. Buying into a market that was fueled by hype and out-of-state money rather than the local economic fundamentals means you're buying at the peak. The smart money is now waiting on the sidelines for these prices to fall back to reality, creating incredible buying opportunities for those with cash like you. Now, the pressure just isn't building in new boomtowns. In some of the country's most established markets, the rubber band of affordability has been stretched to its absolute breaking point. Since 2020, the monthly payment of the typical home has skyrocketed by 82%. Let that sink in. The cost to own a home has almost doubled in just a few years, while wages have not. This is why the international bank UBS now flags LA as having an elevated bubble risk. It has moved beyond expensive into a state of mathematical impossibility for the average family. A faster version of this happened in Provo, Orem, Utah. Fueled by its silicone slopes tech boom, prices went vertical. But now the tech scene is cooling off and the hangover is real. The apartment market is drowning in empty units, with vacancy rates hitting a massive 15%. That's a classic sign that there are way more homes than people who can afford them. That's why CoreLogic has put Provo Orem on its list of markets with a very high risk of a price crash. As an investor, when a market becomes this disconnected from local wages, your pool of potential buyers and high-quality renters shrinks dramatically. It signals a market top where the risk of a sharp price correction is extremely high, and holding assets becomes a dangerous game of musical chairs. Look, there is one simple rule in real estate that no market can escape. You cannot have a healthy housing market if people are leaving. Population is the fuel for housing demand. When the fuel runs out, the engine stops. This is the story of my home state, Louisiana. Zillow's forecast for the weakest markets in the country is basically a list of Louisiana cities. They predict places like New Orleans and Shreveport will see prices fall by over 5%, and with some forecasts going as high as 7 or 8%. Why is this? It's pretty simple. People are leaving. Louisiana is one of only 6 states in the entire country that has lost population over the last decade. Every year, there are fewer families, fewer workers, and fewer buyers competing for the same number of houses. For investors, this is the ultimate red flag. It means you're fighting a losing battle against falling demand, rising vacancies, and a shrinking pool of tenants. It's a clear signal to avoid these markets, as there is no clear path to appreciation or stable cash flow. Our final city is a true wild card, a market that is hanging on a knife's edge. Dallas, Texas has a booming economy on one side and an affordability crisis on the other. To buy a median home-priced home in Dallas, you need to earn about $99,000 per year. The big problem though, the actual median income in the area is closer to $76,000. That is a 30% gap. The market is basically running on fumes and hope. That's why experts are totally split. Zillow says Dallas is basically flat, dropping less than 0.5%. But another firm, ReAdventure, is forecasting a painful 7.5% drop. Dallas right now is a high stakes gamble. If you bet on its continued economic growth, you could win big. But if that growth fetters, the affordability gap means there's no safety net. This is a market right now for seasoned investors who can tolerate significant risk and have a clear exit strategy if the market turns against them. Hearing all of this can be scary, but for an investor, a market shift like this isn't something to fear. It's something rather to prepare for. While others are panicking, smart investors are getting ready to build generational wealth. This is your playbook for not just surviving the 2026 correction, but for turning it into your financial breakthrough. Now, here are 3 rules of survival and success. First, you must learn to become a hawk. In a down market, the best deals are found in the shadows and hiding. This means looking for distressed properties. You can do this by literally driving for dollars, as we call it. Look for homes with overgrown yards. Look for notices taped to the door or mail that is piling up in the mailbox. These are clear signs of a motivated seller who wants to sell fast. You can also check public records for homeowners who are behind on their taxes, and this is another sign of financial trouble. These are the people who will give you the absolute best prices. Second, you must understand that cash flow is your fortress. In a booming market, people get lazy. They buy houses hoping the prices will go up. That is gambling and not investing. In a down market, the only thing that matters is cash flow. This means the monthly rent you collect must be more than the expenses going out. When your property pays for itself every single month, you are protected. You can ride out any storm no matter how prices fall. And third, you have to know when to fold. If you currently own a property in one of these 10 high-risk cities, now is the time to be honest with yourself. You need to stress test your investment. Ask yourself 2 very simple questions. If the value of my property dropped by 20% tomorrow, would I be financially ruined? And if my tenant stopped paying rent for 3 months, would I face foreclosure? If the answer to either of these questions is yes, you may be holding too much risk. It may be smarter to sell now, protect your capital, and wait with the cash on the sidelines to buy back in the bottom. And look, the game is changing. The easy money has been made, but for those who have a map, the real opportunity is just the beginning. You now know where the risks are and you have the rules to navigate them. This is your chance to get ahead as an investor. If this playbook was valuable to you at all, hit that like button and subscribe for more deep dives, and let me know down in the comments which of these markets are you watching.